Fantastic. Welcome everyone to another webinar for Security Token Prime under Security Token Market. Today is a very exciting webinar. We're talking about risk management and tokenized assets, joined by both Murat Farito from Moodys and Tim Reinsdorf from Particula. Gentlemen, how are you today?
Yeah, Jason, I'm doing good. Thank you very much for the invitation. Really looking forward to this webinar.
Pleasure to be here, Jason. Hello.
Fantastic. Thank you both for coming on. We're really excited, seeing some great engagement and questions coming in over the past few days. But let's get started with maybe defining the scope for today's webinar. I think, digital assets has been a widely used term across the industry, Web3. And so to, kind of set the stage, if you will, we are talking about asset-backed tokens, in terms of real-world assets, right? These are securities, these are bonds, debt products, et cetera, not so much on the super Web3 world. But again, obviously, we're not blind to the fact that that is also on the rise. So with that said, guys, maybe we can pull up a slide kind of showing, Particula, to start off with you guys, how you guys classify assets and whatnot.
Yes, so in general, before we started our business at the end of 2022, we outlined a digital asset classification system. And for us, it was really important on the one hand side to differentiate assets based on or tokens based on their underlying asset as a first layer, differentiating between non-asset-backed token and asset-backed token. And then in the next step, really to define on the one hand side, the method. So if we are speaking about tokenization or the adding of additional smart contract infrastructure and the integration of those tokens. So what is the product design? What is the legal framework? What are the utilities? And based on this, we defined the scope of Particula. So the space that we are operating in and providing our analytics and risk assessment as asset-backed tokens. And under asset-backed tokens, we are understanding former analog assets that are natively brought on chain or tokenized. And when we are going one level deeper, we will see that Particula is covering all kind of real-world assets. So we are asset class agnostic. We are looking at tokenized real estate, tokenized commodities, also tokenized environmental assets. But at the same time, and this is also where we are seeing the most market traction, we are focused on financial assets. So this is the broader scope that we are covering. And this, of course, also includes all kind of payment tokens that are backed by fiat, backed by a basket of different kind of assets. And this is also the scope for our webinar today, if I understood it right, Jason.
Sounds great to me. And Murat, do you have anything to add in terms of, what you're looking at in terms of scope and what you expect to kind of cover today?
Sure. Well, I guess from our side, from traditional rating agency perspective, our primary focus will be digital bonds, right? Because we've built many years of expertise rating traditional bonds. So now with growing issuance of digital bonds, we also expand our coverage to offer great ratings for that products. We also rated two tokenized funds recently. Actually, we've used not a traditional credit rating methodology, but rather bond fund assessment product that we have, also part of our product suite. So these are two primary areas that we are focusing on at the moment.
Bonds and funds, it sounds like great use, obviously great to have risk assessment for both on top of other assets as well. So, really excited to dive into that. And I know we're going to do a couple case studies towards the end of the webinar. But, starting off, let's start on a high level. Why is risk analysis, risk assessment so important for capital markets? And how do you see this translating over to digital assets?
I think I can kick it off here because, again, we at Moody's, we have more than 100 years of experience rating traditional bonds. So typically, and I don't want to spend too much time on this question because it's a very big question, broad question. We will not have, enough time to cover it today. But, if we look at the surface, right, what is a credit rating? So typically, credit rating speaks to the credit worthiness of a borrower. So basically meaning if a borrower is able to repay its debt, right? And why is it important? So investors, they would use credit ratings for their investment decisions. And in many cases, if we speak about institutional investors, they would also have some policies whether they can invest in assets with certain credit quality, right? And credit ratings can be kind of a benchmark for for that part. It's also beneficial for the issuers to have credit ratings because based on the rating, they can attract cheaper financing. So the higher rating you get, eventually the cheaper borrowing costs you would pay. Right, so this is kind of in a nutshell why credit ratings are important for this industry.
Yeah, I guess when we also take it on a broader level, so to say, the most important aspect around ratings is to the necessary market efficiency. And so especially when we're looking into the digital asset space, data quality as well as data availability is one of the biggest hurdles. Yeah? So we are seeing different kind of issuers trying to attract liquidity, trying to create the necessary trust from investors. So just what Marat mentioned. And on the other hand side, we have huge information asymmetries. Yeah? So investors are spending dozens of hours manual researching those different kind of tokens, trying to understand them, aggregate not only off-chain data, but also on-chain data. And we need those providers like Moody's, S&P, Fitch in the traditional markets who are reducing those kind of information asymmetries, therefore creating more market efficiency. And the overall aim is to funnel more liquidity into this upcoming market segment.
Makes sense to me. And, this world of blockchain it's relatively new, right, to the rest of capital markets. And so for people that are starting to dive into this and want to learn more, it's hard for them to, well, it'll take some time to learn digital assets. But the other side is, who do we trust? How can we trust these asset issuers and so forth? And so, for those reasons, I think ratings are helpful to bring some of that transparency, helpful to bring some of that trust into this ecosystem for investor participation. So all great things as it translates. And I want to dive deeper into the digital assets part specifically. So, what are some different considerations that you guys have now that blockchain is introduced to some of these more traditional assets?
Yeah, I guess from my perspective, tokenization or the addition of an additional smart contract layer is changing all major product features. Yeah, so independently from the underlying asset, if we're speaking of a single asset, a basket of assets, digital asset, or former analog asset, when you're adding a additional smart contract layer or tokenized stuff, all major product features are different. Yeah? So we have different fiscal compliance, we have different legal frameworks, we have different operational infrastructure, and we need to consider those unique product metrics when we are evaluating on the one hand side the quality, and on the other hand side also the risks that are associated with those new investment opportunities. Yeah? And I guess this becomes more and more important as we are currently already seeing in the market, that the same underlying asset is tokenized from different providers out of different jurisdictions with different tech stack and also different ownership rights. Yeah? And one of the prime examples for this is, for instance, the Biddle fund from BlackRock. Yeah? So you can currently get exposure to this underlying asset by using Securitize. You can exit it via Ondo OUSG. You can get exposure via Mountain Protocols USDM. Yeah? So we have 3 different providers, 3 different allocations, 3 different tech stacks and country of residence, but the same underlying. Yeah? And there we really see that investors need to spend a good amount of time of their due diligence on the token level to really understand what am I buying from who.
Yeah, no, that makes sense. Marat, anything to add? I know we just showed a slide as well provided from Moody's actually, so if you can walk us through that too.
Yeah, absolutely. Well, first, I want to start with our traditional approach is still to look into the credit quality of underlying asset, right? So be it digital bond, it's still kind of a bond for us, right? So we will do our analysis on a traditional front, applying traditional methodology. And on top of it, we will put together technological risk assessment, something similar what Tim has been mentioning and what you can see on the slide as well. But we will not limit ourselves just to the smart contract and potentially asset representation risk. So we will have 4 pillars of the assessment. So one will be the platform risk. So and the platform risk is also important for us because we see that some platforms, especially public blockchain platforms, they had some issues, right? And then we would need to see what happens if, for example, my digital bond token is stuck and I'm not able to prove that I'm the owner of underlying security, right? So those things are also important for us. So as I mentioned, we have 4 pillars of our assessment. So we start with the platform risk, making sure that platform is functioning as intended. And it, of course, is different for public platforms and private platforms. So we may apply different criteria, different measurements for those risks. But in the end, it's the foundation for our analysis. Then we'll also look into the smart contract risk. So we want to make sure that those contracts are properly designed and there has been an proper audit taking place on top of the smart contract. We also look into asset representation risk. So investors, as Tim was saying, they need to understand what they're buying, right? With it holding a token, does it represent that they have a claim of underlying collateral, or is it something else? And including the creditors' rights. So we also want to make sure that if an issuer is issuing traditional bond and then a digital bond, that creditors, they would have the same rights holding, different type of bond here. And the last pillar that we look into is the external risk. So we look into regulatory environment, the cyber, cyber risks that we see there. So one of things we would look into is, for example, if a token is stolen, right? If a bond token is stolen or fund token is stolen, how the hacker can monetize this token? Is there like a secondary market where the token is traded? Is there a way for them to extract the value, or is there a way to freeze the token and make sure that hacker cannot really monetize it? So these are the things we would look into when we analyze digital bonds.
Makes sense to me. And would you say you're comparing essentially, digital asset to digital asset, or are you comparing more so traditional version of this asset to the tokenized?
Well, I would say we're comparing traditional to the tokenized one. We want to ensure that the tokenization doesn't really add any material risk to the traditional one. So that's kind of the core of our analysis.
Makes sense. And I believe I read something along those lines for the SGT Delta Fund, which I'm sure we'll dive into later as we progress. But it makes sense. So it's, in general, it sounds like obviously there's a new list of criteria and things to consider as there's a tokenized version of an asset. Does that change, or is there any other impact based on if it's a tokenized representation of an existing asset, or if it's a digitally native, only available on-chain traditional asset?
Marat, should I, or would you like to start?
You can get started on that, yeah.
Yeah, so in general, it's definitely different. Yeah, so on the one hand side, we have to look on the product design. So the slide which we have currently seen, when you transfer that into particular language, so to say, we would have seen the technology score of our assessment and the legal and compliance score. And we are enhancing this by an additional transparency score, so benchmarking the information that we could get against our data standard of over 300 metrics. And we are also creating some additional scores in regard to the ESG performance and the economic viability. So we are also looking at the economic design of the token, the token's utility, liquidity metrics, and external factors that can impact liquidity. Yeah. And when we are issuing instruments natively on chain, certain risks like asset representation, when the smart contract is done in the right way, can be mitigated. Yeah. So we have to have a closer look on the implementation, and we have to consider the lack of current standards. Yeah, so there is no standardized form of a smart contract, at least one that is adopted across the world. And there are several initiatives around the world. Also in Switzerland, people are very far in regard to standardization, where we are also seeing the upcoming of the first marketplaces, exchanges, where they are only dealing with standardized smart contracts. We are seeing the first solutions of marketplaces from bigger providers where you can create your asset natively on chain and trade it instantly. And when this is done in a standardized way, then for sure it's very easy also for risk assessment to assess those risks. And then, of course, a few, not all, but a few risks in comparison to tokenization can be mitigated. But it's always regarding the implementation. There are no standards. We are seeing so many different kind of solutions. And then what's really challenging is also that when we look at issuances, oftentimes international players are acting at the same time. So we have an issuer or an asset owner based in Europe, then a tokenization provider in the United States, and it's getting traded or in Singapore. Then it's getting really challenging. And then we also have the differentiation between natively issued on chain or tokenized, because we also have to consider legal frameworks in these constellations.
Makes sense. We've seen multitude of assets that are either on multiple exchanges for listing for trading purposes, or on the primary side being offered in the US, and then also, for example, in Singapore, as we've seen with Oasis Score and InvestX, for example. Great way to reach more investors, but also means that you're also, now, introducing a new platform to kind of assess and it may or may not have an impact on the asset itself and its risk. Marat, anything to add to that?
Yeah, I can take an example of digital bond, right? I guess initially when digital bonds were out there, it was a tokenization of traditionally registered bond. So what we see right now in Europe and some countries is that instead of going to central securities depository and registering a bond there, they just create a bond token on the blockchain, which represents the bond, right? It's of course more efficient than doing like both in parallel, But at the same time, we see the risks of, as I mentioned, underlying blockchain or smart contract and so on. So for us, it's always beneficial if the issuer in their terms and conditions document, they would put a clause saying, well, if something happens with a blockchain, with a tokenization part of it, we can always switch to a traditional bond, right? So they would go ahead and register it using traditional systems, and then we become, again, traditional bond known for investors. In some cases, instead of that clause, they put something like saying, well, if something happens to the blockchain, we can always kind of redeem and pay out the bond immediately. So we don't need to face, the situation when we need to register it using traditional channels. So this is what we observe.
Makes sense to me. Obviously, you want to protect the asset and the investor. So that's all great. And diving a little bit more into, I know we just touched on, and introducing new players and whatnot, which kind of segues really easily into my next question for you guys, specifically Tim. Tell me about the differentiation between like an initial assessment and then ongoing monitoring of these assets. And I think one of the reasons I bring this up too is because, as I just mentioned, maybe you have a primary issuance, and then when you can list it on multiple, obviously that adds things. So initial versus ongoing, if you can add some light to that, Tim.
Yeah, definitely. So the major challenge for players like Particula is to follow what is happening. Yeah, we have new market conditions. We can trade 24/7. Yeah, things are going very quick. Things are going in different kind of directions, and we are seeing the need for a shift in approach. Yeah, so when we are looking at the traditional risk assessment or rating industry, usually you have a reflection of a certain point of time. Yeah, but when we look at the technical implementation, the trading activities, and also the risks that are involved, for instance, in regard to the custody provider, in regard to the tokenization provider, and how quick, on the one hand side, roles are changing in the smart contract, and new people can access assets and put them or move them. This is the better word. There's really the need to have this kind of constant monitoring on the one hand side of on-chain activity, on the other hand side of activity on marketplaces, on exchanges, and to adjust a rating based on current data input. Yeah, this is in regard to on-chain data, where we are really nearing real time to get information, also to inform investors about certain risks that can apply. They can apply very quick. And so when we are talking to traditional exchanges, marketplaces, usually they have bilateral contracts with the asset owner, with the issuer, and they have to respond between 24 hours. But when you look at this new market segment and assets can be moved, there can be an exploit or a fraud in 20 minutes, then we really see the need to have this kind of monitoring capabilities on a smart contract level, on a blockchain ecosystem level, on the one hand side to inform investors about certain risks that can be happening, on the other hand side also to highlight potential red flags. And the overall goal is not only to increase security, but also to enable new business cases. So when we are speaking about dynamic ratings that are based on real-time data inflow on and off-chain, we can also create new business cases around it. So for instance, automatic listing and delisting on marketplaces or exchanges when something is happening, to also prevent the marketplace or the exchange of a reputation loss. Or we can create products with dynamic yields based on the quality of the rating. Same goes for indices or active managed portfolios. So there are so many use cases where you need this kind of monitoring and where we are seeing the need in the market to reduce the manual work. And in the traditional world, it's a lot of manual work. It's an agency business to make risk assessment, usually to reduce this to a minimum in order to enable those business cases and give investors the necessary security and trust.
Makes sense to me. And how, and considering that real-time data that you're kind of looking into and whatnot, it's all on chain, more easily accessible. How often would you say you would reassess an asset from an ongoing perspective?
Yeah, so when we are looking at the current situation, we have to differentiate between on and off-chain data. From our standpoint, our rating is programmatic. And so every time we have a data inflow, we are verifying the data, it gets as an input factor into our assessment. So it changes the value over time based on the facts that are happening. And when we're looking at the off-chain world, there's definitely the necessity to, on the one hand side, bring more data on chain, disregarding the underlying asset, but also in regard to the issuer, and create trustworthy data sources where we can create those real-time RWAs. So currently, it's very challenging to adjust a risk assessment based on an off-chain data inflow because there's simply not that much information available around the issuer. The ecosystem is mainly driven by startups and bigger institutions who are engaging, usually put not out the necessary data points you need. And in regard to the underlying asset section, we also need to rely on different kind of providers like Chainlink with their proof of reserve to get those data on chain, to exit it faster, and to enable also our business cases. So currently we're working a lot with web scraping. We have standardized resources for information. We are looking at market analysis. We're looking at social media activity, but it will take time and some additional providers to bring more data on chain to really get into real time and then have the situation that the rating also, or the risk assessment also adjusts every time we are getting new on or off chain data input.
Makes sense to me. And we've seen a variety of, situations where there is on-chain data. The problem is getting permission from the actual issuer to view it or use it. Things that's something that we've seen, through other, I'm glad you brought up Chainlink, and I'm happy, you definitely want to go into new technologies later on or shortly. But we've also seen Invenium that I want to touch on as well, and other providers. But again, it does come down to, again, the issuer to kind of be willing to open up, if you will, and be able to, provide more of that transparency. Some of it is already on chain natively and you can access it anyways, and other information is somewhat, walled off. Murad, are you also doing, ongoing monitoring? What does that look like from a Moody's perspective?
Obviously, we do. So we also have split into two areas. So we have initial rated assignment and then the monitoring part of it, right? And for the monitoring part, we are just trying to test these new capabilities of getting on-chain data. Again, for us, monitoring is, and changing rating is not that as important part of the particular because we don't want our rating to be changed every day. And plus, for us to change the rating, it's not an automated process. It's still required to have a committee sitting together, making decisions, then disseminating. So it may take a couple of days. Of course, if we see some big event happening on the market, we will conduct a rating committee. We will make a rating decision, including known to everybody. But we don't really expect, given everything is okay, ratings to be volatile and change every month or so, right? But indeed, we using blockchain data, we can get faster to the information. Typically, we get quarter past or 1 month past, right? It just depends on what kind of data we will be looking into. If it's a trading data, probably it's not really interesting for Moody's because we don't really affect this kind of things. But if it's like fundamental data, credit-related data, then yes, it will be definitely an interest for us.
Makes sense. Obviously, it comes down to, fund man. And for every asset, by the way, there's different things that we may take into consideration more than others. So it comes down to the asset class. Before moving on, just a quick reminder to everyone viewing, you are allowed to submit your own questions through, the comments section of whatever live stream platform you're using. Obviously, we'll filter them and see which ones are best for our speakers here. But just friendly invitation to bring on your questions as we go along. But moving on, and I did see, earlier when we were talking about, different risk factors that you guys kind of look at, I did see, regulation was one of them, at least to an extent. So I did want to ask, how much impact does regulation have? And do you have an opinion on maybe more favorable jurisdictions than others?
So from our perspective, we see that, regulation plays an important role here, right? So many issuers were very cautious going ahead with the issuance of digital bonds. And they've spent a lot of effort, a lot of money with the legal companies to set up the conditions of the issuances, right? So yes, indeed, some jurisdictions are more friendly to issuance of digital bonds and tokenized funds, some are less. Well, in our case, what we typically do, we just make sure that the issuance that is happening is in line with existing regulation. And if there are some changes anticipated, we also want to ensure that the issuance will be kind of aligned with the future change. But otherwise, this is where we kind of end our assessment in terms of probably regulatory issues that issuers may have while issuing digital tokens.
Yeah, so I would also not give an indication which kind of jurisdiction is better than the other. Yeah, we're currently seeing many kind of different product offerings, product shapings. Every shaping comes with its advantages and disadvantages in some kind. Yeah, I guess the regulation in general is one of the biggest bottlenecks that we are currently seeing, especially in regard to the United States. So based on this year's election, I guess we will have more clarity, at least in regard to certain timeframes where we can expect regulation to come into play. But we are seeing that everybody in the United States, at least the bigger institutions and also a viable startup ecosystem, is working towards the issuances. Many projects are currently in pipeline, but the uncertainty around regulation leads to the fact that many people are doing workarounds into Europe, into Asia, where the conditions might be already in place, or also limited due to sandbox frameworks. So currently we do not see this kind of, at least in Europe, in Germany, this kind of scalable use case in regard to tokenization when we're talking about bigger institutions, because based on the German Electronic Securities Act, most issuances, when we're sticking with bonds and funds, they are private placements, hold until majority, and no secondary market activity. And we need more clarity internationally in regard to regulation to facilitate more activity in the market, especially in regard to secondary trading. And when secondary trading comes into play, then also risk assessment gets more and more important. And I guess Moody's, other rating agencies, and also Particula are building with this kind of vision that what we are setting up now, the assessments that we are creating and the experience that we can get based on those sandbox issuances or in a really limited amount of issuance volume will give us the necessary experience for the future. And in regard to regulation, it will be important that on the one hand side, the issuers understanding better which kind of do's and don'ts are into play, especially when they want to access bigger markets. So the startup offerings are usually not offering in the United States, which is a huge pain point for them. Because we're seeing that the most interest of retail investors is coming directly from there. And we need more clarity in this regard. And I guess when we have more clarity from the United States, then we also see that the market will facilitate.
Glad you guys kind of touched on both, multiple jurisdictions. The U.S. obviously is one that has always been in the spotlight, if you will, from a clarity perspective. We've seen a lot of successful security token offerings. It sounds like, maybe some people may be a little more wary when it comes to, more advanced DeFi-like offerings or aspects to an offering. But with, to your point, Tim, obviously there are the sandboxes and whatnot around. We've seen the UK, we've seen, multiple jurisdictions in Europe, including, for example, the DLT pilot regime that's also in effect. And then Singapore has theirs, obviously, with the MAS and so forth. So lots going on, and I'm sure that kind of plays a role. But at the same time, there are some sandboxes with an expiration date. I'm sure that's also, a factor in your assessments. So if there's anything you guys would like to add there, otherwise happy to move on to another topic here.
We can move on, Jason.
Yeah, fantastic. Well then, Murat, shifting over to you, let's talk about risk and efficiency. Are you seeing some areas where there is a trade-off between risk and efficiency or scaling? And if so, is there a way to resolve that trade-off?
Yeah, that's a tough question. We talk a lot to issuers or potential issuers of digital bonds, tokenized funds, and they always trying to find this middle ground between risk and efficiency. And the spectrum is really, really wide here. So you can imagine one side of the spectrum where you use completely decentralized systems. You can do trading in different DeFi protocols. There is no KYC requirements, no AML requirements, right? And everybody can become a market maker there. And then you see like the other side of the spectrum where you would say traditional, private permission system with players and every roles identified when there is no stable coins or any other like digital cash involved, it's still traditional SWIFT payments. So the issuers that we talk to, they try to find somehow middle ground, which will still be efficient or aiding at least the efficiency and balancing the risk. I'll just give a few examples, and I think you'll get from these examples what I'm trying to say here. So let's take the system of record, right? So we all know that blockchain should serve as the great system of record. It's duplicated on many computers. You don't really need to have a backup solution. At the same time, when we talk to the issuers, we would say, well, we appreciate if you had a backup solution because it just gives us a comfort. And apparently, it's not only Moody's asking for a backup solution, it's also the investors, the market is asking for the off-chain register, off-chain backup. And this is what most of the issuers actually do. Not themselves, but they contract someone else, be it fund administrator, be it the registrar, to offer this off-chain solution for record keeping. Another thing you can think of is the use of digital cash, right? So obviously, have you had like a stable coin, permissionless stable coin, it would be very efficient. So you can trade 24/7, using the stable coin. But at the same time, we've seen that many of them were having some issues maintaining the peg, right? So for the investors, it may lead to loss of their investment, which we want to avoid. So again, from our perspective, the safest option would be CBDC, so central bank digital currency. But at the same time, even if you have a CBDC, right, so it most likely will not be on the same ledger as where you would have your security issue. So you still need to have kind of a bridge solution or kind of cross-chain DVP mechanism functioning there. So in terms of safety, yes, it's less risky solution to have a CBDC, but again, efficiency may suffer from it. So these are kind of the trade-offs between risk and the opportunities or the efficiencies that we see right now. We don't really know where the market would land, right? Which would be the right balance. But we see that many of them are trying to move from like the simple structure, the risk-free structure, to more complicated ones. And of course, it brings new challenges for the issuers.
Yeah, definitely. And I guess, Marat, what you just said is a great example of the many decisions people have to take in the issuance process. And oftentimes it's also about what from an outside perspective looks like an easy decision. Yeah, for instance, what kind of blockchain ecosystem we are using. Yeah, but based on the stakeholder conversations that we are having also with regulatory authorities, it's definitely not an easy to answer question. Yeah, because if you are issuing a token on different kind of blockchain ecosystems, for sure the risk profile of the token is also differently. Yeah, so currently people are spending days up to weeks to only decide this little question, which can be also one of the reasons why the market is moving slow, at least from an institutional perspective, because there are simply no product processes internally for internal risk management. Yeah, so everybody, every asset manager, bank, institutional who wants to get engaged is currently setting up new product processes internally to really understand the risk metrics that are coming from those decisions. And when we were talking, for instance, we spoke with one of the biggest asset managers here in Germany, the usage or the question which ecosystem to use, they have spent a lot of time around it, and there were many questions from the German BaFin in regard to the aspect, what is happening in regard to governance, can you use, or what are the implications if you're using a layer 2 blockchain? So which kind of dependencies are existing? And it's really challenging to answer those questions straight away. Yeah? And therefore, I guess we will have, and also we'll see in the next few months, maybe also the next year, more and more solutions that are more working towards efficiency instead of scalability. We have this discussion internationally. Europe is pretty open in regard to public chain usage. In Asia, in the United States, we are seeing nearly non-issuances on public chains. So people will go the secure way, at least in this period where they are still trying to convince the C-level and drive the first business cases. And therefore, I guess, based from my perspective, security is currently more important than scalability from an issuer perspective. And this is the trade-off that they are currently making.
Appreciate it, both of you. And you guys bring up some great points. Wholesale CBDC side, we have seen, obviously some trials from the European Central Bank and a lot of institutions that have done their own issuances as a part of those trials. In Switzerland, we've seen, for example, the Canton of Zurich, the city of Lugano, all going through 6th Digital Exchange, also using wholesale CBDC settlement, which, Marat, to your point, it's great for an efficiency perspective. But again, what are the risks there? And B, is it even on the same chain? Because you are introducing that interoperability layer. Which is something we've also seen, through Project Guardian, when you're trying to rebalance portfolios across different asset classes, across different platforms, and across different blockchains. Obviously, this doesn't apply to the individual risk assessment of each asset, but in terms of practice, how are people kind of accounting for that? So all great things that you both bring up, and I'm glad we're touching on this. Obviously, the idea here with blockchain is to be as efficient as possible, but we don't want to sacrifice risk, or at least minimize risk as much as possible. So that's fantastic. And then, moving on to, different considerations and whatnot, are there any trends that either of you or both of you are seeing when it comes to, current or prospective issuers that you're working with, or past ones even?
Well, I can share our experience at Moody's, right? So we've started actively rating digital bonds a couple of years ago, and we see that number has been steadily growing, right? And also the complexity, as I mentioned. So initial ones were very simple issuances, now they're adding up the complexity. I guess so far we've tracked more than 60 issuances of digital bonds, and we actively rated more than 20, around 20 of them. So around 30% of the market is something that we were focusing on. In addition to digital bonds, we see a lot of traction on tokenized funds issuance, right? I think beginning of this year, we published a paper where we were looking at the numbers for the past year, where it grew from almost like 0 to 1 billion. And I guess this year, the expectation is that it goes further to 3 billion. So tokenization of funds, where, proper products are being offered on the market with, good structures, which invest in, let's say, UST bills or Singaporean T-bills, the example I want to cover later. Those are, this market is quite booming. And it's not only limited to, the government securities, right? So you also have private credit being tokenized and other solutions. I guess that's the trend that we are seeing right now.
Yeah, I guess from my perspective, what Marat describes, we are currently, when we are looking at the adoption curve, we are in the second phase of tokenization. Yeah, so the first product market fit that we have seen in the market and are still currently seeing are stable coins. Yeah, and now with the introduction of tokenized bonds, tokenized funds, and also yield-bearing stable coins in the current macroeconomic environment, we really saw a push in this direction. Yeah, so we have more issuances, we have more total value locked. Based on my understanding also regarding the proposals that are currently out there. So we have currently in tokenized treasuries 2 billion market cap. Yeah, MakerDAO is allocating 1 additional billion into that. Yeah, so maybe we are ending by 3.5, maybe 4, yeah, in best case scenario. So it's pretty bullish in that regard. And when we are seeing a change, yeah, and when we are currently looking also on the crypto asset side, it's possible currently to get yields above 10%. Yeah, so the question is how viable are those business cases in the future? Yeah, so what we are estimating is that issuers who are currently active in the bond and fund section, especially with big providers coming in like BlackRock or Franklin Templeton, the smaller providers have to move along the adoption curve and focus on providing bigger returns, for sure connected to bigger risks. And what we are seeing is that the issuances of tokenized commodities, especially gold and silver, has increased a lot in the course of the last few months. And also more and more institutional investors are looking on the private debt side, despite protocols like Goldfinch or Centrifuge. And in a later phase, we are seeing that also real assets like real estate and equities will come into the bigger picture. So we are currently seeing a diverse set of equities going to be tokenized, but we are not seeing that kind of demand. Yeah, so when we're looking at this kind of industry adoption curve, we are seeing a disbalance between supply and demand. Yeah, so there's a lot of supply in tokenized real estate equities. Private debt is coming, also commodities, but we have a lack of demand. Yeah? And therefore, we are in this kind of second phase of the curve with the bonds and funds. And I guess we will also have this trend in 2025. The question is where we are heading in 2026.
Makes sense. And that's something that we heard at our, or similar to something we heard at our Tokenized This conference, back in May, which was, there's so many issuers right now of money market funds, liquidity products, as we like to call them, right? Tokenized treasuries or treasury-like, linked products. Which is great, but at the same time, we also have to, realize that is it oversaturated, or maybe a select, handful going to be, the winning issuers, if you will, and that's okay because everyone else that issued a money market fund or a liquidity product has gone through the process of tokenizing, of working with blockchain in an easy to understand product that now they can, to your point, Tim, go move up the risk curve and adoption curve to other products, and maybe they'll be the winners on that end too. So you never know. But the idea here is to A, have experience with technology, and B, Also pay attention to what's in demand. We've seen a lot of tokenized debt. We track $15 billion worth of issued debt, but at the same time, a lot of that is issued from one institution to another, or even within arms of the same institution. Different business lines. So we're excited and curious to see when we'll see a lot more issuances on debt side, closer to retail or individual investor friendly offerings. All good stuff to come on, and I appreciate you guys sharing your perspective there as well. Once again, for anyone that has recently joined us or is still watching through LinkedIn, YouTube, Twitter, or X, excuse me, feel free to submit your questions and we'll get to them if we have enough time. Moving right along though, and this goes back to our tech conversation earlier. Are there any new methodologies or technologies that you are exploring to enhance your digital asset ratings and risk assessments?
I can start again here. So on our front, I think I mentioned the methodology part of it, right? So the new risks that we incorporate in our assessment, those are mainly technological risks, right? And we submit it to our credit rating analyst, and they make the final decision in terms of the credit rating. We also look into different techniques how to get data and how to interact with the blockchain, right? So we are running a couple of POCs with different vendors where we have a direct connection to the platform where the let's say bond or fund is issued, and we can get information directly from this platform and also disseminate potentially information back there, right? So it also becomes a system of first the workflow where we can exchange not only the data but also the actions with the issuer. But of course, I guess data will be the primary resource for us. Basically, that we will not need to receive this manual PDF generated files from the issuer or Excel files. It will all be available on the blockchain instantaneously, so we can retrieve data from there and apply it for our to our analysis. But again, as I mentioned, it's still kind of in the POC phase, so we are testing different things, and we'll see how it plays out.
And Tim, do you want to touch on any tech that you're tapping into? I know you mentioned Chainlink earlier as well, so we'd love to learn more about what's that looking like.
Yeah, more than happy to do so. I guess the collaboration with other providers who are bringing data on chain is very essential to us. On the other hand side, the most important factor is from our perspective to reduce the manual effort that we are putting into our assessments. Yeah, so when we are doing everything manually, we need to create a team of 10, 15, 20, 30 analysts, which is pretty challenging because it's not scalable from our perspective. Yeah, and I'll make a quick example how we are using large language models to facilitate our assessments. Yeah, so we have created web scrapers to monitor the websites of different kind of issuers, especially the terms and conditions. And we are scraping those texts. We have created a programmatic questionnaire based on different kind of aspects we would like to cover, for instance, ownership right, token category, token type. Yeah, and based on the terms and conditions and the answering or the usage of those terms and conditions to answering the questionnaire, we can get a indicative classification of the token type and the token classification. Yeah, every token type and token classification or category is associated with certain aspects. Yeah? So if we are talking about the utility token, if we are talking about a security token, you have different rights and obligations, and you also have different kinds of regulations who are coming into play. Yeah, so we are combining the automated assessment of terms and conditions with a world map that we have created, also based on scraping different regulatory frameworks out of the websites, for instance, from the ESMA, which kind of regulations are in place. Yeah. When we have three information, so we have the token type and category based on the terms and conditions, we know what kind of regulatory frameworks are in place in the country of residence of the issuer, then we can compare it and on the one hand side, create additional data points, verify other data points, or we can generate red flags. So for instance, when we are finding out based on the terms and condition, they are doing regulated business, they are sitting in a country of residence where you need a license to perform those businesses. And within the terms and conditions, we cannot find any information that those licenses and permits are existing on their side, then we can highlight it. And if we would do this manually, on the one hand side, we would need an additional legal team. And on the other hand side, we would need many people spending a lot of time reading over 60 pages terms and conditions, monitoring it. And so we are also seeing very often that tokenization providers, not in the institutional context, but at least in the startup ecosystem, are changing terms and conditions overnight. Yeah, so we would have the need to look every day at every terms and conditions of the issuers that we are assessing. And we have done over 180 ratings so far, or risk assessments. And this would be challenging and not possible for us. Yeah, so the inclusion of those emerging technologies is the quintessence, so to say, of our business. And we could not perform our risk assessment if we would not have those kind of access to those technologies.
Well, I'm really thankful for both of you for putting in the hard work to get this going for investors, for us to track as well. I know particularly we just partnered, and hopefully we can loop in also other ratings as well, for everyone to have access to these risk assessments on individual products. I'm curious to see as it evolves too later on, to add another layer, assets that invest into other digital assets. We've seen Ondo Finance's OUSG invest heavily of their treasuries into BUIDL, which now it's like, okay, well, you're assessing Ondo or USG and you're assessing BUIDL. And I'm curious to see how that converges later on and whatnot. But we are about, a little less than 15 minutes left till the end of our session here. And I do want to get to I think what people have been looking forward to, which is our use cases or case studies. So why don't we start with Particula? You guys have recently done a AA rating for BNVDA, that is backed finance's issuance of NVIDIA stock, and it is now listed for trading on INX. So Tim, walk us through how you got to AA and what you guys were specifically looking into for this rating.
Yeah, I guess we cannot walk it through in 5 minutes. Yeah,
but the highlights.
To give a comprehensive overview how our process is looking like. Yeah, I guess then it's easy to get additional information around our assessment. So on the one hand side, every assessment is starting on the aggregation of public available data on and off chain. And we are utilizing different kind of sources, market analysis, websites, social media, third-party data providers, especially in regard to the data of the underlying asset, in this case, the NVIDIA share. And then we are combining it with a direct relationship to the issuer. Yeah, so we are creating automatically requirement lists that we are forwarding to the issuers with additional points that we could not find publicly available. Usually, we are incorporating the additional aspects and then are going into the one-on-one exchange with the issuer to really understand the product structuring. Even if all informations are available, this is not always easy. And from their perspective, when we have all necessary information, we have understood the relationship to it, we have put it into our system, the rating framework computes itself. So based on the parameter input, when we have verified the information, we are getting the output of this overall score, and it consists of 5 subscores in regard to economic design, compliance and legal, technology framework, ESG aspects, and transparency. And every time we are getting a new data inflow on and off chain, the rating recalculates itself. And in regard to backed finance, it's one of the best ratings that we have published so far with the AA. And this is mainly related to the key strengths that we are seeing in this offering, a highly regulated approach. The partnership with INX, we did this rating for the initial launch of this product, opened up a lot of new markets. So beside US and Canada, it now can be traded nearly across the world. Before that, we were only targeting institutional investors in Switzerland, now retail investors worldwide. And they're combining it with a very experienced management team, a huge or a strong tech stack, and highly regulated approach with a strong user base. And everybody who wants to get some insights into the strengths, but also the challenges that we highlighted as well, feel free to visit our website, go on the back website to get the risk assessment around it. And then if there are any open questions, feel free to reach out to our team.
Very cool. And I appreciate that, Tim. And, my understanding is, obviously we all know NVIDIA is a public company here in the US trading. And then this is essentially a security token that offers you, redemption to, 1-to-1 per, one token is one NVIDIA stock that they have custodied and whatnot. Is there, custody solutions that you have looked into that, you kind of favor more than others and whatnot to, accommodate for a situation such as this, a tokenized stock versus a natively issued tokenized equity?
Yeah, so you have to look into different kind of providers. So what we are currently building are comparative analysis between different custody providers, but also tokenization providers. And to stick with the custody example, there are many metrics we are looking at. For instance, the insurance, the kind of coverage of different kind of blockchain ecosystem, reputational factors, whitelisting, multi-signature for moving assets. Yeah. So there are several aspects, and you need to perform those different kind of comparative analysis to really understand what is the impact in regard to custody. And first of all, you need to differentiate in the first step, are we talking about self-custody, third-party custody, or institutional grade custody? And then you can go from there.
Makes sense to me. All things to consider, especially in the U.S. as well. We look at qualified custody versus other and whatnot, and obviously that also goes into their licenses and what makes them qualified as a custodian, aside from their actual operations as well. So, moving over to Murat now, let's go into your case study. I think we suggested the SGD Delta Fund. This was issued by Singapore's Fund Bridge Capital on Standard Chartered's Liberia platform. And you guys also gave them a AA rating. So, Murat, can you walk us through this fund, assessment and what came into consideration?
Absolutely. Just one addition here. So we gave them AA-BF, which means bond fund rating. As I mentioned, it's not a traditional credit rating, but it's a bond fund rating. But essentially, yes, AA-BF rated was our first fund, tokenized fund that we have rated at Moodys. So on this slide, you can see a very high-level structure or players that are participating in the fund. So you can see a new party, Liberia, which is a technology solution provider. I guess before it should have been a transfer agent that they're replacing now with this new party, because transfer agent becomes redundant here. So what happened was that Fund Bridge Capital, they have set up a fund or sub-fund, which is fully tokenized, and they invest in Singaporean T-bills. If you can move to the next one, I'll just quickly explain the structure of the transaction and then how we approach this, right? So actually, this is a very simplified process flow of tokenized fund issuances, and it's kind of native for the crypto investors, even though they already allowing for traditional investors to have the fiat currency, but this is the original setup that they had. So what happens here is that investor would send their tokens. In that case, it was stablecoin backed by Singaporean dollar to the token wall. And then it had to be converted to traditional fiat currency. So the issuer of the stablecoin took part of that. And actually, this was one of the things we were looking into to make sure that the fund itself doesn't really hold any stablecoins. Because I think I mentioned before that there is the risk, even though it can be a trust issue of the stablecoin, there is always the risk of a defect situation, right? So even if funds had this stablecoin exposure, our models would show different results. So what we see here is that they send their stablecoins, and then stablecoins are converted to traditional currency, and traditional currency is used to purchase underlying securities on the bond, and those securities are kept with a trusted custodian. At the same time, when this is happening, the token is minted and sent to the investor wallet. So it's kind of in a native process for crypto investors, because they send that token and they receive something back to their crypto wallet, right? So in the case of this fund, there was no secondary market trading available, and every investor, so every token holder, they had to go through KYC process, and their wallet has to be whitelisted. So as I mentioned before as well, if the token is stolen, there is nothing, there is no place how you can monetize it, and you can even force, freeze the wallet or force the token transfer, and the permission nature of the token was allowing for it. So that gave us some comfort from the cyber risk perspective, that the hackers would not really have an intention to kind of hack anything within the smart contract or any other step of the process. So this allowed us to issue AA-BF rating to this fund.
Makes sense. And my understanding is that it could have easily been, a AAA rating actually, but there was some hesitation and brought it back down to a AA. Can you tell us a little bit about those specific factors that kind of brought the rating down actually?
Yeah, absolutely. So looking at the assets, indeed, the assets, underlying assets will be rated as AAA, right? But on top of analyzing the asset quality, we put together some operational risks that are around this issuance, right? So in this case, we were not saying that the use of technology or blockchain technology itself was negatively affecting the rating. It's rather the experience of the fund manager dealing with the technology, right? And again, those ratings in the future may converge to the rating of underlying security or underlying assets that they hold, but we just need to make sure that this experience is growing and fund managers become more familiar with the technology, and the whole ecosystem is kind of getting more robust and protected from outside kind of invasions that may happen with cyber risk and everything related to that.
Makes sense to me. Obviously, we do still want to protect our investors and make sure that they are aware of risks that come along with this technology. It's not perfect. So glad that you guys are being honest there, obviously, and giving it, honest feedback, despite how obviously I think we're all in line of we want to see this technology thrive and whatnot for so many reasons. But with that said, Murad and Tim, thank you both so much for joining us and sharing so many valuable insights with everyone. I think this has been, really informative for current issuers, for potential issuers, even for the platforms. I think, to get a better understanding of, if they're not already optimized, how they can best, serve their clients and their issuers and whatnot. So all great stuff. Is there anything that you want to share with us as some parting thoughts before we close out the session?
From my perspective, not. Murad, from your perspective?
No, we're actually very curious to see how the market is going to develop, and looking forward to further conversations with you and the rest players in the ecosystem.
Fantastic. Well, everyone, check out Particula. Obviously, we're all familiar with Moodys and all the developments they're both doing, really. With future risk assessments to come out. Obviously, we will be covering them as they roll out as well. For any research that you guys want to do on tokenized assets, you have plenty ready and available for you on stm.co. As well as any research that Particula Moodys also has available for everyone. So with that, thank you all for joining us. Share this webinar to anyone that you think may be beneficial. It may be beneficial for. And with that, thank you all. Happy tokenizing. Have a great day.
Thank you.
Thank you very much, Jason.